You are listening to KeyStone's Stock Talk Show, episode 299.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to chat with you again. This week, I will kick off with part one of an article on what the picks and shovels approach is in investing and a couple of stocks that we posted in that article that are good examples of that, including briefs on Shopify, Nvidia, and Argan. Aaron answers a viewer question on entertainment giant, the Walt Disney Company, symbol DIS or DIS, on the New York Stock Exchange. Brennan tackles a question on Deere Co, symbol DE, on the New York Stock Exchange, which engages in the manufacture and distribution of various equipment worldwide. It has performed well post-pandemic, but the momentum has slowed of late. He lets you know his take on the valuations at present. Finally, Brett takes a look at the shift in U.S. policy being away from renewables as the various Inflation Reduction Acts, tax credits, and incentives look to be changed. And he takes a look at the surging nuclear segment after Trump signed an executive order to speed up the development of nuclear power with the intention to quadruple the country's nuclear power within 25 years. Brett narrows in on nuclear company we interviewed a couple months back at a conference, Centrus Energy, symbol LEU, on the New York Stock Exchange, on the heels of my review of Atkins Real. I can't say the company. Atkinson Realis Group, symbol ATRL, on the TSX in a segment last week. All right, let's get to the show. Now that I butchered that, the poll question this week. Let's get to it.
Get to the poll question. So
do you want to just move to that, or is there anything else we want to talk about?
I think we can get straight to that. It's in tune with both I think you're in Aaron's segment. So the question was, if you want to invest in gold, what is your preferred investment method? So 36% of our viewers said gold producer companies. 17% said picks and shovel, gold service or support companies in that context. 33%, so a nice third, said physical gold. And then 14% said other. We had, notably, I would say the one which doesn't really fit into any of those would be the royalty streamer companies, which someone commented. Then we had the ETFs, as well as just someone highlighting Sprott, Newmont, and then someone just saying they prefer to buy physical gold over ETFs or financial products, which I will say just within that context as well, there's pros and cons to both. Not only for physical gold, if you're comparing to an ETF, you'll have worse spreads for physical gold because they're providing you a physical product. They have to ship it to you and all that. I think normally it's 5% or so versus an ETF is fraction of a percent. And then you're paying whatever 0.2% a year. And it's just whether or not that's your trade-off there. If you want to deal with even holding the gold, if you want to hide away in the safe or under your mattress, or I think Brennan has a hole in his yard which he tosses his gold into, just to let all our audience knows where if you want to dig for gold, good spot. But yeah, I don't know if you guys had any comments there on it.
I don't own a house yet.
I'm flying to Saskatoon.
Go on, Don.
Sorry, the one thing that I'm going to say is that if you want to actually invest in gold, maybe the best thing to do isn't to buy a gold stock, because a gold stock, and many of them are great, don't get me wrong, but a gold stock is more of a stock than gold. And we've done research on this. We've shown, now companies are going to vary, but we've tracked, for example, Barrick, which is one of the biggest, most diversified gold producers in the world. We tracked its stock performance going back 25 years against the price of gold. And I mean, trust me, if you wanted gold exposure, you didn't want to invest in Barrick. It basically did nothing but go up and down, at least at that point in time. I haven't checked extremely recently, but whereas gold did extremely well. So two completely different things. That said, there are opportunities in gold stocks. I would just look at that as more of a stock that is dependent on gold and would indirectly benefit from gold, as opposed to an actual investment in gold.
Yeah, and Aaron has an excellent article coming out. It's already on the website. It's on the front of the website, the Small Cap Gold Stocks Playbook, 7 timeless rules for picking winners. Check that out at www.keystocks.com. Next week, he's going to go over that in a segment. So, look forward to that. I've got a segment on the picks and shovels approach in the gold segment as well, as a way to play the high price of gold that we see right now in the market.
Yeah. I'd just like to add, like, typically, I voted, services or picks and shovels. It's not that I haven't, invested in a producer before. We had a recommendation within our US coverage. I believe it was around $11. I think we ended up taking profit at, $16 on the stock. It paid a nice dividend, 5% yield over that time. And it was a producer, but again, the thing there is they had recently sunk a new shaft. We were seeing, this increase in, guidance for ounces that they were actually going to be producing. So again, at least if the price of gold goes down, you've got this increase in ounces from a business like that. But just generally, I typically have, been investing in, the drillers or the millers of the world.
The millers.
Yeah.
Yeah, and the millers and the drillers. No, we've done very well with that approach. It's a great approach to balance out your risk. And one of the things, the highest risk in that sector, and there are literally thousands of these in Canada, are the junior explorations, and we haven't touched on that. And many of them are exploring for gold. That is pure speculation, and we would steer clear of that. In terms of investment dollars, it is very difficult to make what is classified as a true investment in that sector. We always say you'd have more fun going to Vegas and just throwing your money down on black or red because you'll lose as much money investing in that segment. It is very hard to actually invest. You're just pure speculating. So there are some producers. It's very difficult to make money in those. The gold price has to go with you. You have to have the company, the underlying cash flow go with you in that business as well. But I would stay away from the exploration companies is what I'm trying to say. All right, let's move on. I'm going to bring up my segment here, share my screen. Now I'm going to start off by looking at the picks and shovels approach. This is part 1 of the picks and shovels approach, but the full article can be found on our website at www.keystocks.com. In that article, I define the picks and shovels approach to investing. I show you how to find picks and shovels stocks. That'll be next week. Detail a unique gold drilling opportunity, which is Geodrill Limited, GEO on the TSX. Provide a number of real examples of picks and shovels companies, including Shopify, Nvidia, and Argan, and tease 2 unknown gold-related picks and shovels stocks. That is the synopsis of the article right there. Now, Mark Twain is credited with saying, when everyone is looking for gold, it's good to be in the picks and shovels business. Now, the picks and shovels approach to investing in stocks involves buying companies that provide the tools, services, and technologies needed to support a larger industry rather than investing directly in the major product or services businesses. The strategy is rooted in the gold rush of the mid-1800s. Gold from the American River is a famous quote. This fevered cries could be heard daily from San Francisco newspaper publisher and merchant Samuel Brennan. Not Brennan, Brennan, as he paraded through the streets of San Francisco holding aloft a vial of gold. Rumors of the gold discovery were confirmed in March of 1848, starting the California gold rush, where over 300,000 people came to California with gold in their eyes and the dream of becoming rich. Only a handful succeeded, and Samuel Brennan was one of them. In fact, he became what is widely thought to be the first millionaire of the gold rush, not by mining the gold, but by capitalizing on the needs of miners and selling them picks, shovels, and pans. When you pan for gold, you're betting everything for a big windfall, one binary outcome. It either works or it doesn't. Customers either love it or hate it. Extend this to investing in gold exploration stocks. They either hit gold or they miss. It's boom and or bust, and very high risk. But if you buy a stock that services gold exploration companies, one that, say, mills, drills, or provides software to exploration or production companies, they get paid hit or miss, not mess. With gold at record highs, we included a picks and shovels gold services stock one can buy today below. We'll talk about that next week. It'll be Geodrill. The picks and shovels businesses are, of course, less glamorous, but their consistent profitable growth has a higher chance for success over the long term. Now, where is the money made long term? Well, these kinds of companies have a huge advantage. They profit from broad industry success rather than a single winner. It's not just the gold industry we're talking about here. Some of the biggest companies in the world are built on this model. We can look at, from Canada, Shopify. The trend here that was identified, millions of businesses needed a way to sell online. Shopify provided the tools. Today's Shop powers billions in transactions and takes a cut from every sale. Now, investors who identified the stock early have made massive profits. Since IPO, the stock is up over 4,000%. $1,000 invested in 2025 when Shopify went public would be worth over $40,000 today. Honestly. Consider Nvidia. The trend, every AI company needs massive computing power, and Nvidia chips are the industry standard. No matter what company wins the AI race, they all run on Nvidia. That's why the shares have jumped nearly 1,350%, or over 1,350% in the past 5 years. Or consider a recent recommendation of KeyStone's Argan Inc, symbol AGX on the New York Stock Exchange. The trend here, AI data centers require vast amounts of power due to the complexity of computer calculations, specialized hardware, cooling requirements, and large-scale data processing. Argan provides traditional and renewable power infrastructure across nearly the entire energy industry. It offers low carbon, zero carbon fuels such as solar facilities, wind farms, biomass projects, gas-fired power plants, and battery end-to-end storage facilities. Now, Argan was recommended just under $50 just over a year ago, and the company has jumped actually now over 300% since this picks and shovels buy was recommended to clients. We can see the stock here just over the past year. It is up since our recommendation of over 200%. Okay, now let's look at what drives a company's growth like this. This is the Q1 results that came out from this company. Tremendous growth in revenues, tremendous growth in gross margin, tremendous growth in net income and EPS. Argan serves as this is the balance sheet as well here. I'll take a look at that. Cash-rich balance sheet here. Tremendous increase in cash flow, net liquidity, shares were repurchased, and the project backlog, which is really the positive here for the long-term outlook of this company, up to $1.3 billion from $757 million in the same period of the prior year. Next week, but that does serve as an excellent example of a picks and shovel stock in a booming segment and how rewarding it can be. Next week, I'm going to look at how to find picks and shovel stocks, starting with identifying the trend. All right. Mercifully, I'm through that.
Yeah, that increase in backlog is just significant. And again, it was a cash-rich business. It's just always nice when you can, be finding a cash-rich business with, in a booming industry, like you were saying.
For sure. Yeah. And then that, we went through around 2,000 companies with net cash positions, profitability, and that is one of the companies we pulled out. And again, it fits that picks and shovels approach to a segment. You're not directly investing in AI, but you're investing in a company that provides the server to power to the server farm. So it's a couple layers back, but certainly the infrastructure that is needed to build out the infrastructure that is needed for AI, I guess we're saying. So 2 steps back, but certainly a picks and shovels approach.
And what I would add on to that is just really combining those two thoughts, the balance sheet versus identifying what trend it is and really where it is that 2 steps back is. If you are on, we'll just keep going with the AI. So if you're looking at an AI service company, most of them are young companies, they're venture capitalists, they need to raise money. They do not have that balance sheet. So even if you end up being correct, you might not even get as a public shareholder, get your money's worth, because they do need to issue shares. That's what you see in these companies. Most of them aren't going through debt, they're going through equity markets. You're going to get diluted. So even if the product is good, doesn't mean your investment was good.
It's such a good point. Like the difference here is the mounting cash position allowed them to massively increase their dividend. They pay a dividend. They bought back shares. And in a contract-driven business, it provides them with somewhat of a margin of safety. So even if we think we got the trend right, and we believe we did get the trend right, it's a massive trend here. Even if we didn't, they had some margin of safety there. But if you do, this is your upside, and it's been tremendous. And even with those gains, we'll look at the numbers and we update our clients in the coming weeks. This stock still isn't trading at a massive multiple, and can buy back more shares and can increase its dividend. And it has that backlog. You have to monitor that backlog. If the backlog starts to come down, we'd be out of this company. It keeps mounting. So at that point, we keep holding it. Okay, I think that segment took a while, at least on the back end here. No one probably saw, but we had a computer fall down. It was impressive. There was gymnastics being done in the background. Whatever.
But you got through it.
Yeah, but see, the show must go on. So we're going to have Aaron tackle the Walt Disney Company. Entertainment giant just had quarterly numbers out. Myself and Aaron have brought our families there so many times. We've probably keeping them in business at this point. But, great park to visit, do the numbers match? And is it a good investment now is what we're going to look at.
So obviously, this is a company that does not need an introduction. The Walt Disney Company, symbol DIS, on the New York Exchange, trading at $109, almost a $200 billion market cap company. And I believe they just recently reinstated their dividends. So a little tiny yield there of just under 0.9%. So when we think of Disney, of course, we think of Mickey Mouse, we think of the parks, maybe even the cruises, but it's a very diversified media company. So it's divided into different segments, media networks and sports. So this includes different streaming services, including Disney Plus, ESPN Plus, and Hulu. There's the studio entertainment, which is the content production, direct-to-consumer streaming services, and then experiences and products. So these are the theme parks, resorts, cruises, and other types of products, like if you buy that overpriced original Mickey Mouse souvenir, like I did, and overpaid for it. So if we look at the 12-month stock chart here, it's really hard to judge a company by their stock chart in 2025. Obviously, a lot of volatility and recovery, as we've seen by many companies. Looking at the 5-year chart, Disney has really not done that much for investors over the past 5 years. Really would not wanted to have bought early in 2021. And it's really just kind of traded in a range for most of the last couple of years. But the company did just recently come out with its Q2 2025 results. They were, by all metrics that I was able to analyze, good, strong results. Revenues up 7% to $23.6 billion. Income before taxes was $3.1 billion versus $0.7. Adjusted EPS 145, up 20%. So good numbers in the Q2. Now, the income adjusted before taxes, that's obviously a big growth. There are some one times, but the adjusted EPS really gives a more normalized view of what happened in the quarter. So that 20% growth rate in per share earnings is strong. Like, that's what we would consider a strong growth rate if they were able to maintain it. Looking at the 6 months numbers, revenue up 6%, cash from operations up 84%, and then free cash flow up 100%. Now, obviously, that kind of growth is not sustainable. The cash flow from operations and free cash flow will fluctuate from year to year. But nice to see that good, strong free cash flow. And then looking into the current year, guidance, midpoint of adjusted EPS of $5.75. So that would be 16% year over year growth. So it looks like a good outlook as well. What are the company's key areas of growth? Well, there's their streaming service, obviously Disney Plus. Actually, my subscription actually lapsed to Disney Plus, but I am planning on renewing it. So this has been considered a big growth driver of the company. The direct to consumer operating income again strong. Launch of ESPN standalone DTC service, and then looking at the parks experiences operating income up 13%, consumer products up 14%, new cruise ship and multiple park expansion projects are happening. And then if you look at the studio and licensing, they're looking at strong upcoming theoretical slate and content licensing growth, which is probably why they're expecting another year of double-digit growth here. Now, what about the threats and the weaknesses? Well, people think Disney Plus streaming, there's a lot of opportunity there, and there is, but it's a highly, highly competitive space. Rising programming costs pressure the margins. You've got other players, a lot of players coming to market, and now people are starting to feel a little bit stretched on their streaming expenditures. I know I felt like that. When Netflix came out, it was like, wow, I could replace my cable with one or two streaming services and save a bunch of money. But now to get a really good, slate of programs, you need to have 6 or 7 streaming services, it seems. So a lot of competition, subscriber trends, Q1 Disney Plus subscribers did slip a little bit. That is not a great sign. There's the macroeconomic and operational risks. There's a lot of macroeconomic uncertainty and headwinds, and this is ultimately a consumer business. Now, I do believe that there are aspects of the company that is somewhat defensive given the strong branding and diversification. But, if we're in a recession, people are going to spend less money on Disney cruises and parks and whatnot. Now, there is this talk about a massive decline in tourism into the US. One would wonder, well, how does this affect their park business there? That decline is real. I mean, those are, as far as I know, absolutely real numbers, and they are severe or significant, rather. Now, but how does that affect Disney? I'm not sure it would affect them too much, because that goes back to the diversification of the company. They have parks all over the world, right? I mean, they have parks in Paris and Japan, other places. So even if they lose business in some of their parks, they could gain some business in others. So, but still, it does have the macroeconomic risk, leverage and rates. I'm not, debt levels have come up a little bit. They're not too excessive, about 2.4 times debt to EBITDA for a company like Disney is not too bad. But they do have some debt, so there is some interest rate risk there. Balance sheet, we just talked about it. Net debt, $40 billion, debt to EBITDA, 2.4 times. I'm not, that's not an excessive number. That's within the range, but I would also consider it fully leveraged. I mean, I'd probably rather see 2 to 2.5. It's in that range, but I don't want to see 2.5 to 3. I wouldn't get nervous, but once you get over 3, you are. So it is definitely a fully leveraged company, in my opinion, if you want a well-structured balance sheet. Valuation, just going off the midpoint of guidance, 19 times earnings, 16% growth rate. I all things equal, I consider that to be a very reasonable valuation. But what is our take? Obviously, a leading global brand and a very well-diversified company. I think strong fundamentals overall. I do think that is a reasonable valuation based on the numbers that they are expecting now and what they just reported in the quarter. But I'm gonna give a caveat there, and that's that, Disney has not been a consistent growth story where you're getting that double-digit 20 or 16% growth year over year. So we can't just model that in and expect it's going to happen. There's some fluctuation in the company's earnings. We would monitor subscriber trends at Disney Plus. That's pretty important if things continue to decline or that accelerates. And then, of course, there's the macroeconomic exposure and risk. So we're just going to continue to monitor. It's not a buy for us. I think long-term, you could buy it. Very investable company, good fundamentals, but we're just monitoring.
Yeah, I think that's the thing. And realistically, you covered it, the fundamentals are trending, in the right direction. I think when you covered it last in September of 2023, net debt to EBITDA was, trailing was 3.5 times, I believe. It's down, to about 2.5 times, like you said. I'm pretty sure adjusted EPS was declining. Now they're projecting back to growth. But again, you covered that where, the company isn't, consistently putting up, these significant adjusted EPS, growth figures every single year.
Yeah, let me tell you, I'll just say that if I was expecting 16% growth every year, 19 times multiple for a company like that would be, we wouldn't be having this conversation. I'd just be putting in my order, right?
Yeah.
But it all comes down to how confident are you that they can maintain a double-digit growth rate. Mm-hmm. So.
Yeah, and they've had some fluctuation on that spottiness on maintaining a growth rate in that area long term.
Big time.
Yeah. For sure. Okay. Let us move on. Aaron reviewed Disney. I think we're going to have Brett, or is it Brennan? Brennan. I think
Doesn't
Brennan's
matter.
going to, whatever you guys want. Deere. We might as well do your stock, our take. Let's have Brennan do Deere Co.
We could have rock, paper, scissors for it.
Pre-show.
Yeah.
Or live.
Live, yeah. Rochambeau. Okay.
Do one right now. See, just do one. No. Come on.
I've already shared my screen. So yes, this question comes in from one of our clients, Daniel. So thank you, Daniel, for this question. On Deere Co, or DE, on the New York Stock Exchange, currently trading at a price of about $510 per share, about $140 billion market cap, and a dividend yield of about 1.26%. They engage in the manufacture and distribution of various equipment worldwide. The company operates through 4 different segments: production and precision agriculture, small agriculture and turf, construction and forestry, and as well as financial services. Now, the stock has performed very well since pre-pandemic, up over 210% since before the 2020 drop. And this was led by a significant inflection in net income, where they were growing EPS, or earnings per share, with a compound annual growth rate of about 15% from 2015 to 2019. But they actually increased this to 20% from 2019 to 2024. So we saw an inflection over the last 5 years. Now, looking at the most recent quarter for Q2 of 2025, ended April 27th, 2025, revenue declined 16% to $12.8 billion. Looking at the individual segments, production and precision ag businesses revenue was down 21%, primarily due to lower shipment volumes, with operating profit down 30%. Small ag and turf revenue was down 6%, again, as a result of lower shipment volumes, but operating income was actually up 1% due to lower production costs, lower warranty expenses, and price realization. Construction and forestry revenue declined 23% due to, again, lower shipment volumes, and operating income was down 43% in that segment. And financial services net income was down about 1%, but it remains a small piece of the business. Now, the company updated its guidance, which it previously provided in February, its fiscal year 2025 guidance, decreasing the bottom end of its previous range, its net income range of $5 to $5.5 billion, and they've now decreased that low, or that bottom end, to $4.75 billion, but maintaining that top end of $5.5 billion, which at roughly the midpoint would be a decline of about 21%. From fiscal year 2025. And this equates to a forward price to earnings multiple of about 26 times. And if we look at the median price to earnings multiple over the past decade, the stock has typically traded at about 16 or 17 times trailing GAAP earnings or accounting earnings. Now, looking at each segment, they are expecting each industry and segments revenue to be down or flat. And looking at the segments, they're looking at each segment revenue to be down about 15 to 20% roughly. And management's indicating that increased interest rates and tariff impacts are leading to shifting market demand. So at this point, to sum up this slide at least, the company is certainly facing headwinds, and compared to its historical multiple, it is trading at a premium at this point. Now, looking at the balance sheet, it remains quite levered with a trailing net debt to EBITDA multiple of 6.1 times, but we can see that the company's share count continues to decline, which is positive for EPS. and is why we have actually seen, EPS decline at a slower rate than net income in the last few quarters. Looking at some operational updates, the company acquired Centera last Friday on May 23rd, a company with industry-leading cameras, which are compatible with most major drone platforms that enable farmers and crop scouts to quickly and efficiently capture high-resolution data at scale. They also announced in April that it was investing $13.5 million to expand its remanufacturing facility in Missouri. And both of these, are just essentially part of the company's continued investment in its smart industrial strategy, highlighting a planned $20 billion investment in the US over the next decade for product development, technology, and manufacturing. So, to conclude here, near-term headwinds are facing the business, with revenues of all segments expected to be down this year, as well as net income is going to decline compared to 2024. The company has a good track record of producing mid-teens EPS growth, but did increase it to about 20% from 2019 to 2024, which was positive for the business and why they were demanding a higher multiple. The balance sheet is quite levered with a trailing net debt to EBITDA multiple of greater than 6 times. So I do think that it is a bit on the higher side and something to keep a watch on. And the company is certainly facing headwinds, and compared to its historical multiple, it is trading at a premium at this point. So again, at this point, I would be a bit hesitant to build a position in the stock and believe it is closer to fair value, in my opinion. I don't think that it's a bad business, great brand name. They have grown their dividend at a 5-year growth rate of 15% with a payout ratio of just under 30%. This could increase as earnings may decline in fiscal year 2025. But again, earnings growth has been good. The business has been buying back shares and has, a smart industrial roadmap for continued investment. But again, I just think I'd be hesitant entering the stock at this point in time with elevated multiples and these headwinds in fiscal year 2025. And here is the disclosure.
Yeah, you got elevated multiples, headwinds, and it's a good long-term business, but in the near term, the market should know that earnings are coming down, revenues are flattening to coming down. So, I would look for a better entry point if you like Deere long term.
And I'm really surprised that the stock price, hasn't really, had a major pullback, just with the headwinds and tariffs. And from my understanding, they do have manufacturing in several countries, including Canada. I believe that they've got a facility in Langley. But, a majority of manufacturing, again, from my understanding, is in the US. So again, that's something to keep in mind.
All right. Well, let us move on to Brett last but not least, looking at the shifting U.S. policy kind of away from renewables and narrowing in on nuclear segment after the POTUS signed a executive order to speed up the development of nuclear power. And I had talked last week about kind of a backdoor way into nuclear power through Atkinson Realis.
You got it there, I think.
Yeah,
you got it.
I don't know. Atkins Realis, ATRL, to play it that way. Now we're going to look at a little more direct way.
Yeah, so as well off of that, briefly talked about how renewables have really been a shift away from U.S. government focus. The Inflation Reduction Act, which is what Biden brought in, had a lot of tax credits and incentives for solar, wind, and renewables in general. And right now, what's passed the House but not passed the Senate in the U.S. would remove quite a lot of those incentives. But whether it goes back and forth and to what degree, that's really unclear at this time. We'll probably by the time this is posted, you'll have a different bill than what is in the House right now. We're recording this on the Monday. So, but what has been a recent winner in the policy shifts under Trump looks to be nuclear. So a couple of days after the solar stocks plummeted, nuclear stocks really surged across the board as Trump signed an executive order to speed up the development of nuclear power with intention to quadruple the country's nuclear power within 25 years. There's quite a few to say the least, analyst skeptics of that degree, but it is at least supportive environment for nuclear growth. The shift in policy is looking at an overhaul of the Nuclear Regulatory Commission, NRC, a reduced time of regulatory licenses and decisions for construction to 18 months, as well as some other limits. Reevaluation of radiation limits, standardization of applications for microreactors, amongst many other things, and we'll really see how it comes out if it actually comes into proper legislation as well, past an executive order. But it is an area to watch. And nuclear stocks just absolutely surged on Friday after the order. So Uranium Energy Corp, a uranium exploration and processing company, UEC is the symbol, was up 25%. Oklo, symbol OKLO, a small modular nuclear reactor company, up 23%. Cameco, I think that is Brennan's favorite, symbol CJ on the New York Stock Exchange, as we're going to go all off American here, was up at 11.1%, just to name a few. But the company I do want to focus on in this segment is Centrus Energy, symbol LEU on the New York Stock Exchange, was up 21.6%. But those are just a few examples. Effectively, the entire industry and anything even remotely to do with nuclear was up on Friday, and the ones that were focused on nuclear were up big, as you can see from those double-digit increases. I'm really looking at Centrus, and this is, I guess, a my stock, my take, just because I find the company interesting. It's where it's positioned. It was formerly part of the U.S. government prior to this IPO. It's in quite a bit of a niche, as there's only a handful of competitors which are non-public and have some or historic government involvement, and it has long-term prospects, and we talked to them as well in person at a conference in March. So Centrus Energy is a supplier of nuclear fuel and services. The company was spun out of the U.S. government in 1998. The company produces high-assay low-enriched uranium, or HALEU, as well as low-enriched uranium. And it is the only company to produce HALEU within the U.S. with a U.S. supply chain and U.S. technology to enrich the uranium. The company breaks its operations into two segments, a LEU broker business and a CTS segment, which is enrichment and technical services. So an interesting position given the deglobalization policy, especially from the US, that we've been seeing, considering it's all focused within the US, and it's really a US nuclear pure play is what I would really call it as. The stock is trading at $113 a share and has a $1.9 billion market cap. The stock has performed great, not just due to the recent executive order, but over the past year, it's up 122%. So there's just more than the executive orders, where some of those other companies, they weren't doing as well, and the executive order prop them up. But shifting to the financials for Q1 2025 on March 31st, the company had revenue of $73.1 million, up 67%, of which the LEU segment was $51.3 million, up 117%, and the CTS segment was up 8% to $21.8 million. Gross profit substantially increased off the back of that increased revenue to $32.9 million from $4.3 million. Net income as well increased substantially to $27.2 million compared to a loss of $6.1 million, or on a per share basis, $1.60 per share for this quarter compared to a loss of 38 cents in the prior year. But I will mention at this time the company has significant quarterly variations to the contract timing, primarily in the LEU segment. So while it's good to see these high growth percentages, the comparison was generally compared to a lower year, and you need to really take a step back for this company, as it relies much more on longer-term trends over individual quarters. You just see up and down on a quarterly basis. Looking at a longer-term view over the past 10 years, as well as the trailing 12 months, we can just see there's a general improvement. The company went from unprofitable on a per-share basis to profitable, and as well you can see the revenue per share, and they've done administration or SG&A cost expense cuts over the past decade, and they've shifted more into a profitable company, so that's really good to see. Just as a long-term trend, and the revenues obviously came up on a pretty positive trend. So balance sheet, great balance sheet. The company has cash of $653 million, debt of $457, so net cash position of $195 million. So great to see that net cash. As well, I will note as well, though, they do have a pension and post-retirement liabilities combined of $76 million, which isn't the biggest, but I always do like to highlight that because we've obviously slowly moved away from pension over the last really 80 years, but some of these older companies or spun out of government organizations they do have these retirement or pension liabilities still on their balance sheet. So it's always good to watch out for those, because some companies, which I have seen, a bit of a tangent, it will be a massive pension liability, and they end up needing to restructure it, and it can really harm the company for even years at a time. The company, as it does rely on those long-term contracts, it's good to really keep an eye on them, and it's really a key metric for the company. So for backlog, they have 3.8 billion in revenue backlog and this is until 2040. So like I said, very long-term contracts, of which 2.8 billion of that is in the LEU segment. If we do see this proliferation of commercial nuclear, not weaponized nuclear, like what you normally hear when you say proliferation, you should see that show up in the backlog in the coming years as well as decades. And that is really the key metric which you want to be looking towards for a forward-looking metric. So valuations on a trailing basis, the company is trading at a PE of 17.7 times, an EV to EBITDA of 6.6 times. Not exactly cheap after the really surge in price of the stocks over the past year, but the prospects as well as obviously improved over the past year. But I would say that is quite expensive at this time. But given the volatile nature of the stock and due to the speculative nature of really the entire nuclear industry, as well as now coupling with policy, which can be volatile given the administration, there may be periods of time which becomes more appealing on a price basis, even if all else stays equal. So we'll see how that plays out. The long-term speculative prospects are appealing given the niche positioning within the US enrichment market, having effectively no national competitors. If we do see sustained shift to commercial and government demand for nuclear power, the company could become very appealing. But it is slow growth industry over the long term, and as well, it has lots and lots of speculation embedded in the stock, given the industry at this time. Overall, we will continue to look more in the company as both the company and environment really develop, and just generally monitor for a better risk reward trade-off. And for disclosure, we have no position or relationship with the company.
Yeah, it's a good overview. It was an interesting interview we did in California with the management team, and they explained the business to us on lay terms, which was nice, and to get that explanation and get a better understanding. As far as loosely in that sector, maybe a little, although Atkins Realis, as like reading it right now, has a little bit better valuations, but again, that stock has surged even in the past couple weeks as well. So certainly a heated sector, one to watch, one to see if there is some companies that can play into that. Maybe some Atkins maybe can be a company that we call a picks and shovels, to bring it full circle for that sector. All right. I think that is all for this week. Any further comments? Anything we need? I think we're good. If you are listening to this or watching it, wherever you watch, if you're on YouTube right now, smash that subscribe button. If you're listening to this, wherever you consume your podcast, rate and review us. Keep your questions coming in for our Your Stock, Our Take segment, and we'll endeavor to answer those. And as always, I wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.